Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Quantinuum.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a really useful chart tool for investors and traders. Like, if you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Yeah, it's super handy.
It really is. VIP Algos is a TradingView indicator suite that shows visual buy and sell chart alerts. It has trend direction tools, support and resistance zones, and even take profit and stop loss planning areas. And you can use it across a bunch of markets like stocks, forex, crypto, gold, indices, futures, and more.
Right, but we always have to remind everyone, VIP Algos is an educational chart analysis tool only.
Exactly. It is absolutely not financial advice. It doesn't place trades for you, and it obviously does not guarantee profits. Trading involves risk, so always manage your risk and, do your own research. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so let's jump in. Imagine you hold the literal blueprints for, the next era of human computing.
Oh, wow. Yeah.
Like, we're talking about technology so fundamentally advanced that it basically makes our current supercomputers look like wooden abacuses.
I love that comparison.
But here's the catch.
Yeah.
Wall Street expects you to show a predictable, quarterly profit on it by next Tuesday.
Yeah, which is just impossible.
Totally impossible. And that tension is exactly what we are watching play out in real time with Quantinuum right now. We're looking at a company that just pulled off this massive $1.68 billion initial public offering.
Right, a massive IPO.
Exactly. The stock priced at $60 a share, and right out of the gate, it opened at a premium and just ripped all the way up to over $71.
Which, that's exactly what you would expect from a highly anticipated tech debut, right? The momentum was just explosive.
It was, but then the floor just completely vanished.
Yeah, it was brutal.
The price action rapidly washed out, tumbling all the way down to $54 by day 2.
Honestly, my immediate reaction when looking at this is just, pure skepticism.
I can understand why.
Because, you have a stock that drops 24% from its high in less than 48 hours. You really have to wonder, did the initial momentum traders just, dump all their shares on retail investors who were late to the party? Is this public offering just fundamentally broken right out of the gate?
It's entirely natural to look at a 24% swing right after a debut and feel highly cautious. But what we are really witnessing here is the market trying to price in something that is notoriously difficult to value.
Okay, how so?
It's this concept called the quantum chasm.
The quantum chasm, that sounds intense.
It is. This is the massive, murky gap between, groundbreaking, world-changing deep tech innovation and actually recognized predictable commercial revenue.
Yeah, I see. Yeah, so the washout you are seeing is the market wrestling with a really tough reality. This company has the potential to fundamentally redefine global computing power, but it is absolutely not going to show traditional, stable profits tomorrow morning.
Okay, well, let's unpack this wealth-building context. Because if the short-term price action is this brutal, how should an investor even frame this in their portfolio?
That's the key question.
Because to me, it sounds like anyone trying to day trade this is just, asking to get burned.
They absolutely will get burned. When you look at Quantinuum from a wealth building perspective, you have to understand that this is fundamentally not a short-term trading flip. It just doesn't fit that profile in any way. What our research points to is a long-duration, highly speculative growth play. Yes, it carries substantial risk, but mathematically, the reward potential is equally scaled up.
Makes sense.
The entire opportunity for an investor here is completely dependent on the company hitting very specific, highly complex future hardware milestones.
We are talking about the system slated for the end of the decade, right?
Yeah, precisely. They have two major systems on the roadmap. There's the 2027 system known as Sol and the 2029 system known as Apollo.
Okay.
So this is for an investor who wants foundational exposure to a generational technological shift. It's absolutely not for someone looking for immediate income, dividends, or, value-based stability.
It really reminds me of trying to buy into the physical infrastructure of the early internet back in like 1994.
Oh, that's a really good analogy.
Right. If you were investing back then, you weren't buying the polished software or the highly profitable e-commerce platforms that came a decade later.
Definitely not.
You were essentially investing in the plumbing of a completely new era of human capability.
Uh-huh.
And when you are funding the plumbing of the future, you have to expect extreme gut-wrenching volatility and absolutely zero short-term profit. You are literally paying for the blueprint of tomorrow.
That is a perfect way to look at it. You are paying for the architecture before the building is even constructed. And if we connect this to the bigger picture, that architectural phase requires a staggering amount of capital.
Oh, for sure.
Which completely explains why their current ledger looks the way it does. Now let's look at the fundamentals.
Yeah, here is where it gets really interesting. Because if you just glance at the headline financials right now, they are, frankly, ugly.
They really are.
And I am going to push back hard here.
Yeah.
Because you are looking at a first quarter 2026 revenue contraction of 73% year over year.
Right.
They brought in just $5.24 million. And alongside that shrinking top line, their net losses are widening, hitting $136.5 million.
That's a big number.
So how does any company justify going public and commanding a multi-billion-dollar valuation with shrinking revenue? A 73% drop isn't just a bump in the road. That looks like the wheels are falling off the wagon entirely. How do you possibly pitch that to the public market?
I know it sounds incredibly alarming until you look under the hood at how their business model actually functions at this specific stage of development.
Okay, enlighten me.
The key to understanding this company is distinguishing between their recognized revenue and their booking backlog. Yes, recognized revenue dropped to just over $5 million, but their full year 2025 bookings stood at a massive $79 million.
Wait, let me make sure I understand this. So booking means they have the massive enterprise contracts already signed, but the money just isn't hitting the official income statement yet.
Exactly. This is the lag that happens when a company transitions from an R&D phase into commercial enterprise operations.
Oh, okay.
Research and development milestone payments are extremely lumpy. A government agency might pay $20 million in one quarter for reaching a specific research goal and then literally nothing for the next 3 quarters.
Right, that completely skews the year-over-year comparison.
Exactly. Now, they are shifting to enterprise contracts, which take time to fulfill and legally recognize as revenue on the balance sheet. So the financial pipeline isn't dead at all, it's just deferred.
That makes a lot more sense.
And this brings us to their technological moat, which is why those enterprises are signing the contracts in the first place. Quantinuum operates what we call a full-stack model.
Meaning they don't just build the physical machine, they control the software too.
Right. They control the enterprise software application layers, like their TKE middleware. This creates incredibly high switching costs.
Oh, I see where this is going.
Think about it. Once an enterprise spends millions writing proprietary algorithms optimized specifically for Quantinuum stack, they are effectively locked in. If they wanted to switch to a competitor, they would have to scrap years of code and rewrite everything from scratch.
Okay, but software lock-in only matters if the physical hardware is actually better than the competition. Is the underlying technology actually proving out, or is it just theoretical? Because, we hear a lot of noise about different types of quantum computing.
The hardware is their true competitive advantage. They utilize something called trapped ion quantum computing.
All right, explain this to me like I am 5, because my eyes usually glaze over when we get into quantum mechanics. What is trapped ion, and how is it different from what companies like Google or IBM are doing?
Fair enough. So companies like Google and IBM generally use superconducting qubits. Think of a superconducting qubit like trying to balance a spinning plate on a stick in the middle of a windstorm.
That's stressful.
It is. It operates incredibly fast, but
Yeah.
it is highly unstable. A tiny temperature change or a stray magnetic field can knock the plate over, ruining the calculation entirely.
So it is fast, but really fragile.
Exactly. Trapped ion technology, on the other hand, uses electromagnetic fields to suspend individual charged atoms, usually ytterbium or barium, in a perfect vacuum.
Okay.
It is like locking that spinning plate inside a climate-controlled, vibration-proof underground vault. It is a bit slower to operate, but it is insanely stable. And because of that stability, their Helios system just achieved a 99.921% 2-qubit gate fidelity and features 48 logical qubits.
Fidelity essentially means accuracy, right?
Yes, fidelity is everything in this space. It is a measurement of error reduction. Without high fidelity, quantum computers just generate useless, random noise instead of actual answers.
Right.
A 99.9% fidelity means the system can run long, complex calculations without the data corrupting itself.
So what does this all mean for the balance sheet? Because building a climate-controlled atomic vault sounds like it burns cash at a terrifying rate.
Oh, it does, which is why the capital they just raised is the most important part of their financial picture. Their post-offering balance sheet is practically flawless right now.
That's a strong word. Flawless.
Truly, that $1.68 billion capital infusion completely insulated them. Even at their current massive cash burn rates, they have over half a decade of cash runway.
Wow, 5+ years.
Yeah, they do not have to worry about near-term debt crises or going back to the market to raise funds anytime soon.
Okay, but even with an ironclad balance sheet, the market's patience is not infinite. With that kind of cash burn, investors are going to demand proof of life soon. So I guess that brings us to the catalyst timeline, right?
Yes, absolutely.
How long before the market loses patience, waiting for those massive backlog contracts to actually hit the bank account? What are the catalysts we need to be watching?
The biggest immediate event to watch will be their second quarter earnings, which are estimated for late August or September. The entire market is going to be hyper-focused on one single metric, the conversion rate.
Meaning the backlog.
Exactly. Are they starting to turn that $79 million backlog into actual recognized revenue? If they show even a slight acceleration in that conversion, it completely shatters the bearish narrative of a shrinking top line.
What about the broader corporate structure? We have the Honeywell Aerospace spinoff happening on June 29, 2026. Is that just corporate restructuring noise, or does it actively impact Quantinuum's future?
It is deeply relevant, and here is why. Honeywell currently retains a roughly 48% voting stake in Quantinuum. When Honeywell spins off its massive aerospace division, it fundamentally changes the parent company structure.
Right, because aerospace is their bread and butter.
Exactly. By removing the stable, slow-growth aerospace revenue, it shines a massive spotlight on the remaining Honeywell entity. Suddenly, Honeywell's most valuable growth asset is arguably that exact 48% stake in Quantinuum.
So it forces the market to properly value the quantum asset instead of burying it under jet engine sales.
Exactly. It could lead to a strategic reevaluation, perhaps tighter operational integration, or even position them for future mergers and acquisitions. And beyond corporate structure, we also have to consider the macroeconomic environment.
Right, the elephant in the room, interest rates.
Yes. The broader market has been pricing in higher for longer interest rates, which acts like financial gravity on long-duration tech stocks.
Yeah, growth stocks hate high rates.
They do. But any macro pivot toward rate cuts disproportionately benefits speculative names like this, because their valuation is entirely based on future cash flows. When rates drop, those future cash flows become mathematically more valuable today.
So if this macro reality and these upcoming catalysts are swirling around, what does this actually look like when we pivot to the chart? Let's talk about that violent drop.
Looking at the price structure, the initial action was incredibly volatile, but the mechanics behind it are fascinating. The $60 IPO price acts as a psychological magnet and a floor.
Right.
The reason it washed out to $54 was due to the underwriters. Initially, lead underwriters like JP Morgan and Morgan Stanley engaged in stabilization efforts. Like, they actively bought shares on the open market to support the price. But the moment they stepped back and halted those efforts, the stock slid rapidly.
So the natural organic buyers just weren't there yet to catch a falling knife.
Exactly.
The chart looks incredibly messy right now. And I'll just say, when you have a massive drop like that without natural support, traders dealing with this kind of extreme volatility often look for clean chart workflows. Something to help visualize the data, just to identify where the actual support zones might be forming in the wreckage.
Absolutely. And part of the reason for that extreme chart volatility is the float dynamics. The stock is in a discovery phase right now, trying to find a base. But the float, meaning the actual number of shares available to publicly trade, is exceptionally thin.
How thin?
82% of the equity is currently locked up by insiders and early backers.
Wow. 82% locked away. That means only 18% of the company is actually changing hands on the open market.
Yes. This constraint means the supply of available shares is artificially low. If a positive news catalyst hits, say, they announce a major acceleration in revenue conversion, You do not need a lot of buying pressure to trigger a violent momentum rally to the upside.
Just because there's nothing to buy.
Right, simply because there aren't many shares available for short sellers to borrow or for regular sellers to offload.
It sounds like a powder keg. So who is actually holding the matches? What does market sentiment look like right now?
I would define the mood as cautious excitement. The market is definitively bearish on the immediate financial readouts, but heavily bullish on the long-term strategic technology.
Okay, that tracks.
You are seeing massive institutional and government signaling that supports the bullish side. For example, the U.S. Department of Commerce recently earmarked a direct $100 million investment into Quantinuum. They are treating this specific technology as strategic national infrastructure.
I have to push back on that, though. Does a government grant actually prove the tech is commercially viable? Or is this just like a geopolitical defense play?
What do you mean?
Like, maybe the government just wants to keep next-generation decryption technology out of the hands of global adversaries, regardless of whether it can actually make a profit for a private enterprise.
That is a very valid question. Government funding doesn't always equal commercial success, but you have to look at what the broader profit-driven private sector is doing in parallel.
Okay, such as?
Microsoft recently announced their own internal roadmap, aiming to deliver a commercially viable, scalable quantum system by 2029. That independently validates Quantinuum's exact timeline for their Apollo system.
Oh, interesting.
Plus, you have Quantinuum signing a memorandum of understanding with Mitsubishi Electric to explore computational fluid dynamics.
Wait, why fluid dynamics?
Because simulating the chaotic movement of fluids like air over a wing or water through a turbine is incredibly difficult for classical computers. Quantum computers are uniquely suited to simulate natural physics.
That is fascinating.
And on top of those partnerships, during the public offering, sophisticated tech investors like NVIDIA's venture arm, Inventures, and QED held onto their stakes. They did not cash out. That signals deep, long-term institutional conviction.
But even with NVIDIA's venture arm and the U.S. government on board, things can still go wrong. So let's talk about the risks. What takes this company down?
We cannot ignore the revenue concentration. If you look at their 2025 revenue, roughly 60% of it came from a single source.
Really? Which one?
Japan's Riken Institute. That is a massive single point of failure. If that relationship sours, or if Riken pivots to a different computing architecture, the current revenue stream practically evaporates overnight.
That is concerning. But honestly, what terrifies me more for the retail investor is the share structure we talked about earlier.
Yeah.
You mentioned that 82% of the equity is locked up by insiders.
Yes.
That creates a massive looming cliff for December 2026 when that lockup expires. The mechanics of that are brutal. When insiders are suddenly legally allowed to sell millions of shares, that is a potential flood of supply hitting a very thin market.
It's a huge supply shock, potentially.
Right. That can absolutely crush a stock price, no matter how good the underlying technology is.
That lockup overhang is a very real structural risk, and it will be a major test for the stock. However, you have to consider who actually holds those locked up shares. The biggest player is Honeywell.
Okay.
They are a strategic, long-term industrial anchor. They aren't some impatient venture capital firm looking to quickly dump shares on the open market just to return capital to their limited partners.
That's a fair point.
Furthermore, because Quantinuum just raised $1.68 billion, the company itself has zero urgent need to raise capital, which heavily reduces the pressure for insiders to sell at distressed, washed-out prices.
Right. They aren't desperate for cash.
Exactly. The risk of a sell-off is absolutely there, but it is somewhat mitigated by the quality and the time horizons of the primary shareholders.
So with everything on the table, what is the final verdict for the listener?
Based on our research, the bullish score sits at a 7 out of 10.
A 7 out of 10. Okay.
But that rating comes with a heavy caveat regarding time. This is fundamentally a multi-year target horizon. You are aiming at the successful execution of the 2027 lull and 2029 Apollo hardware milestones.
It's all about the long game.
Exactly. To summarize the broader picture, the main upside driver here is their undisputed technological lead in trapdoor computing, fortified by a massive cash fortress that practically guarantees their survival through the development phase.
Right.
The main risks are purely execution-based, like can they convert their backlog into recognized revenue quickly enough to satisfy Wall Street? And how smoothly will the market absorb the looming December lockup expiration? Ultimately, this opportunity is suited strictly for speculative, long-term investors who can stomach extreme volatility. As always, this analysis is not financial advice.
And if you want a cleaner way to read trading charts while you navigate that volatility, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
Yeah, it's a great tool to have in your kit.
It really can help make charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this discussion helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.
Thinking back to that 1994 internet infrastructure analogy we discussed, sure, laying the plumbing of the future is incredibly expensive, and the price swings will absolutely make your stomach drop. But it leaves you with one really uncomfortable question as an investor. What happens to your portfolio in a decade if you decide not to own the plumbing, and the whole world suddenly turns on the faucet? Something to think about.